Indonesia, a rapidly developing nation, relies heavily on tax revenue for its growth and progress. Taxes, mandatory contributions made by citizens and corporations, form the backbone of the nation's finances. They are essential for funding public services, infrastructure projects, and social welfare programs that benefit all Indonesians. Without a robust tax system, the government's ability to provide essential services and promote economic development would be severely hampered. The importance of taxes cannot be overstated. They ensure a steady stream of income for the government, enabling it to invest in critical areas such as education, healthcare, and transportation. These investments, in turn, contribute to improving the lives of ordinary citizens, creating jobs, and fostering economic growth. Therefore, a fair and efficient tax system is crucial for Indonesia's continued development and prosperity. Indonesia's tax system has undergone significant transformations over the years, aiming to enhance efficiency and increase revenue collection. One of the most notable changes was the shift from an official assessment system to a self-assessment system in 1993. This transition empowered taxpayers to calculate, deposit, and report their taxes directly to the government, streamlining the process and promoting greater transparency. The self-assessment system relies on the principle of trust and accountability. Taxpayers are entrusted with the responsibility of accurately assessing their tax liabilities and filing their returns honestly. This system encourages voluntary compliance and reduces the administrative burden on the tax authorities. To facilitate this process, the Indonesian government has introduced various initiatives to educate taxpayers about their rights and obligations, making tax filing easier and more accessible. Financial engineering, a complex and often controversial practice, involves manipulating financial transactions and accounting methods to achieve specific financial goals. While not inherently illegal, financial engineering can be used for unethical purposes, such as minimizing tax liabilities through sophisticated schemes that exploit loopholes in tax laws. Companies engaged in financial engineering often employ a range of tactics to reduce their tax burden. These may include transfer pricing, shifting profits to low-tax jurisdictions by manipulating the prices of goods and services exchanged between related entities. Tax havens, establishing subsidiaries in countries with minimal or no corporate taxes to park profits and avoid higher taxes in their home countries. Hybrid instruments, using complex financial instruments that blur the lines between debt and equity to exploit tax advantages in different jurisdictions. The palm oil industry, a major contributor to Indonesia's economy, has been plagued by allegations of tax avoidance through financial engineering. Some companies in this sector have been accused of employing various tactics to minimize their tax liabilities, depriving the government of much-needed revenue. One common practice is misclassifying income and expenses to reduce taxable profits. For instance, companies might categorize capital expenditures as operating expenses to claim larger deductions, thereby lowering their tax burden. Others might manipulate transfer prices for palm oil products sold to related companies in low-tax jurisdictions, effectively shifting profits out of Indonesia. Section 5. Implications of financial engineering on tax compliance. The prevalence of financial engineering poses significant challenges to tax compliance and revenue collection. By exploiting loopholes and engaging in aggressive tax planning, companies can significantly reduce their tax liabilities, depriving governments of essential resources needed for public services and development projects. This erosion of the tax base can have far-reaching consequences. It can lead to reduced funding for public services. Less tax revenue means less money available for essential services such as education, healthcare, and infrastructure. Increased inequality is another consequence. When corporations don't pay their fair share of taxes, the burden shifts to individuals, exacerbating income inequality and, finally, unfair competition. Companies engaging in aggressive tax avoidance gain an unfair advantage over their competitors who comply with tax laws, distorting market competition. Section 6. The importance of detecting tax avoidance. Given the detrimental impact of financial engineering on tax compliance and revenue collection, it is crucial for tax authorities to develop robust mechanisms for detecting and preventing such practices. This requires a multi-pronged approach that combines legislative measures, technological advancements, and international collaboration. Tax authorities need to be equipped with the necessary tools and expertise to effectively identify and investigate suspicious transactions. This includes data analytics, utilizing sophisticated data analytics techniques to analyze vast amounts of financial data and identify patterns indicative of tax avoidance. Transfer pricing audits, conducting thorough audits of intercompany transactions to ensure that transfer prices are in line with market rates and prevent profit shifting. Information exchange, collaborating with other tax jurisdictions to exchange information and intelligence on multinational corporations suspected of engaging in cross-border tax avoidance. Section 7. Strategies for mitigating tax avoidance. Addressing the challenge of financial engineering requires a comprehensive strategy that combines legal reforms, capacity building, and international cooperation. By working together, governments, tax authorities, and international organizations can create a fairer and more effective international tax system. Key strategies include strengthening tax laws, closing loopholes and enacting legislation that specifically targets aggressive tax planning schemes used in financial engineering, enhancing tax administration. Providing tax authorities with the resources, training and technology they need to effectively detect and combat tax avoidance. Promoting transparency. Encouraging greater transparency in corporate financial reporting to make it more difficult for companies to hide profits and engage in tax-motivated transactions. Section 8. The role of technology in combating tax avoidance. In today's digital age, technology plays a crucial role in combating financial engineering and tax avoidance. Advanced data analytics, artificial intelligence, and machine learning algorithms are proving to be invaluable tools for tax authorities worldwide. These technologies enable tax authorities to analyze massive data sets, process and analyze massive volumes of financial data from various sources, identifying patterns and anomalies that may indicate tax avoidance. Automate risk assessment. Develop sophisticated risk assessment models that can identify high-risk taxpayers and transactions, allowing for more targeted audits and investigations. Enhance information sharing. Facilitate real-time information exchange between tax authorities globally, improving coordination and effectiveness in combating cross-border tax avoidance. Section 9. Conclusion: a collective effort for a fairer tax system. Financial engineering poses a significant threat to tax compliance and revenue collection, undermining the fairness and integrity of tax systems worldwide. Addressing this challenge requires a collective effort from governments, tax authorities, international organizations, and businesses themselves. By working together to strengthen tax laws, enhance tax administration, promote transparency, and leverage technology, we can create a fairer and more effective international tax system. This will ensure that corporations contribute their fair share to society, enabling governments to fund essential public services and invest in a more sustainable and equitable future for all.